So let's talk about loans and loan programs. And this is often the part that people get excited about. This is also the part where people go, wow, there's so many options. So one thing to talk about loans and loan programs, again, this is the California edition, so there's going to be some California-specific loan programs, but some of these down payment assistance programs that we're going to discuss do exist in certain incarnations in your local counties and states and so forth outside of California. But don't be overwhelmed. The goal of what your loan officer advises on is to steer you to the right loan program and advise you on which is the correct program for you, and also justifying it. But knowing what's out there and knowing how these things work is gonna make you a better home buyer. So types and terms. You got fixed rate loans, right? As the time of this recording, we're very much in a fixed rate loan environment with low interest rates. You've got adjustable rate loans, which can be a tool if your goal is not to own the home for very long and you've got the income or comfort to obtain an adjustable rate mortgage. I strongly advise using the fixed rate loan program. And it's been several years since I have originated a adjustable rate mortgage for someone purchasing their primary residence. You've got 30-year terms, which are the most popular, especially in California. You got 15-year, and then of course 20 and 25, or any term of loan is available technically. You could have a 27-year term, 19-year term, 8-year term. So let's talk about loan programs or types of loans. So here, paper flipping, I'm trying to make sure I'm on the same page with some of these little reveal answers. The reveals are to keep you paying attention, so keep you on our screen. So conventional loans are your typical 20% down, or a loan where you put less than 20% down and you have private mortgage insurance, or what's referred to as PMI. PMI is not an evil thing. It basically says that the insurance company will pay the lender if the loan is made to guidelines but the loan does not perform or the loan defaults. So you'll have more PMI with less down payment. Okay, and they are private insurance companies that provide private mortgage insurance. So when you do a PMI conventional loan, you'll have a 3, 5, 10% down type scenario. And you'll want to have a higher FICO, higher income when we're doing PMI conventional loans. So obviously it's great if we have a 20% down payment, but I'll tell you very rarely in working with first-time home buyers do we have a 20% down payment, 15, 10, sometimes even 5% is stretching it. So don't feel bad if you're not in the 20% down category, or even looking at conventional. So we may be looking at the other types of lower down payment loans, which is the FHA, or the Federal Housing Administration, or Housing and Urban Development, or HUD, offers FHA financing, which is a great loan program which allows for a 3.5% down payment and a minimum FICO of 640 for most FHA loan programs, a minimum FICO of 580 for the program I'll talk in a future slide here. So you can get 3.5% down with a 580 FICO with certain other guidelines. At the time of this recording, you've got a 1.75 upfront financed mortgage insurance premium that's added to the loan and paid back to HUD at the beginning of the loan. Now, when you say upfront, that doesn't increase your closing costs, so don't be confused that you have to pay 1.75, almost 2% of the loan, so it doesn't add to your closing costs. It's added to the loan, and it's paid for as part of your monthly mortgage payment. So with FHA, we have mortgage insurance monthly, but we refer to it as MIP, or monthly mortgage insurance premium. Same as PMI, but it is a little higher with FHA than conventional, although the guidelines on that change somewhat frequently. And the down payment on FHA may be a gift. That's probably one of the most unique things about FHA financing is mom or uncle, grandma can gift all or part of the down payment for FHA. Conventional allows gift, but we got to have a 5% minimum contribution for the buyer. So if you do a 3 or 5% down payment, none of it can be gift in the last 60 or 90 days. But with FHA, the entire down payment and closing can come from someone else. It must be a family member or a non-occupant co-borrower. There are certain wedding gift programs as well. I know that some of our attendees are here because of some newlywed home buyer marketing that we do. So there is some other guidelines with FHA loans surrounding wedding gifts. But basically, the gift needs to come from a family member, someone with an established relationship. The other bullet here that's at the end, the family member may act as a non-occupant co-borrower, basically means, say, mom, dad, uncle, grandma can co-sign the loan and doesn't have to live there. So they can add income to the equation is the way to think of that. So let me catch my breath, and I see a couple questions coming in, and we'll get to those as we get to the end. Let's keep on moving. So FHA Choice, if there's one loan program that we receive the most inquiries on online, it is this one. FHA Choice is simply a great program. Most banks will not lend an FHA loan below 640 credit score. At our bank, we do permit credit scores 580 and above, so 580 to 639, as well as 500 to 579. So with a 3.5% down payment with your own funds up to 620 FICO, 10% down payment below 580. But we do need some other requirements to get the FHA Choice loan approved. We need better employment history, so we need to be 12 months at the same job, same line of work. We need to verify very closely the last 12 to 24 months rental history, and we want to look for the amount of reserves at closing, so at least 2 months or more. And we do require that all home buyers complete a HUD-approved home ownership workshop. Unfortunately, this webinar does not qualify as a HUD-approved workshop. I think it should, but it doesn't. So maybe we should put some Q&A as we go and get it approved. So VA, so veterans in the house, you guys, thank you for serving, and you are given a very unique benefit through the Veterans Administration of the VA Home Loan Program. It is a government guaranteed financing that permits 100% financing, no down payment. There's simply a funding fee that's attached to the loan. There's no monthly mortgage insurance. We take a look at, when we're pre-approving you, your certificate of eligibility. We take a look at who's on the loan and a bunch of other factors that are unique and specific to VA loans. Who's going to be eligible? It's going to be retired U.S. veterans with a certificate of eligibility, active duty with proof of military service, or you'll have unmarried surviving spouse for folks that died in an overseas or service-related death. So Coast Guard, all Navy, Air Force, Marines, Army, and so on. So typically, if you're VA eligible, you know about it, but a lot of veterans forget about it. They just forget. They forget. I served in Vietnam, served in Korea, I was in the military in the 80s, and they just forget about the certificate of eligibility, they forget about VA financing. It's a great tool. If you're married, your spouse can be on the loan. If you're unmarried and buying with your your partner, if you will, that person can't be on the loan. Right, so you can't add a bunch of co-borrowers to your VA loan. And you can only have one VA loan, and if you buy a second house and you have an active VA loan on the other house, you're not going to be able to renew and get a new eligibility for government guarantee. So moving on, any questions about VA? Okay, terrific. So let's talk about a fun one, and this one changes all the time, but it's always there, and it's a great program. Excuse me. And that is USDA. And we're not talking about USDA as in who grades your meat. We're talking about rural financing, or the Rural Housing Service. So part of USDA's charter is to help banks improve financing in the rural areas, the non-suburban, non-urban areas in this country. So it provides 100% financing, zero down at the time of this recording. In this live webinar, we are at a 2% guarantee fee, which is financed back to the loan. It has a significantly lower monthly fee, or MI. We don't call it mortgage insurance. It is paid monthly for the entire life of the loan, but right now it's 0.4%, which is roughly a third of what FHA charges. And the rates are the same as FHA and VA, very low government-insured rates. There are income limits, so you can't make too much and qualify, but don't assume that you won't qualify. They're very generous. They're based on the median income in the county that you're purchasing, and they're based on the number of occupants that will be in the house. So if you're living in the house and you've got 2 kids, you've got 4 occupants, let's say grandma lives with you too, well, we count her income in the income limits, but maybe not for qualifying. Maybe we don't put her on the loan, but grandma would count as the 5th occupant, for instance. With most USDA financing, you'll see a minimum FICO of 640 and above, and it's for eligible properties. So how do you determine if your property is eligible? Well, I'll show you a website, and there'll be some links that you can get. So it's going to be outside the urban core, outside the major highways, but you'd be surprised how close you can be and still be USDA eligible. Always use a direct lender, and this is something that we didn't talk about before as far as direct versus broker. Broker is someone that sends a loan to another lender and essentially arranges the loan but doesn't lend the money, doesn't underwrite or approve or process the loan. A direct lender is someone that actually makes the loan at the end of the day. So always use a direct lender for USDA. There's certain niche loan programs that are a little unusual that you don't want a broker that has no control doing it, and one of them is USDA. Just going to take twice as long, and they're going to mess it up on occasion. So here's an old screenshot that's current at the time that we're recording this, but at the time that you watch this, this may have changed. It shows our location of our office north of Santa Rosa in the Larkfield Wickiup area. It shows Santa Rosa down here, Windsor up here, and it basically shows that all of this area of Windsor, whoops, is eligible, all right, and there are certain demarcations. So this system allows you to click on property eligibility, click on single family residence, right here, and basically type in an address and get an immediate feedback as to whether it should be eligible. And it's not guaranteed. They may make some mistakes, but it's nearly 99.9% guaranteed that the property will be eligible if you type in the actual address. This site, and I'll send the link out with the rest of the information, does have income eligibility information as well. So you can type in the number of occupants and the amount of monthly income and find out what the current median income limit is for, and you're going to look for the guaranteed home loan program. There's something in there called the direct program that we don't want. So we don't want direct, we want guaranteed. Okay. Direct is only made directly through USDA, where they lend their own money. It's for ultra low income type situations. So moving on, whoops. One of the California specific loan programs that we just love and is a great benefit is provided by a state agency called the California Housing Finance Agency. And it's a 30-year FHA mortgage or other government insured loan. It's for California residents only, for first-time homebuyers that haven't owned a property in the last 3 years, that are buying their primary residence. It is, of course, income limited. It does have a max loan amount of $417, and it does have some max purchase prices too, but most counties they're pretty much irrelevant. There is a down payment assistance program that's synonymous with CalHFA called CHDAP, or CHDAP, California Home Buyers Down Payment Assistance Program, which is basically a 3% silent second that you don't pay interest on on a monthly basis. There's simple interest that accrues, and if you ever refinance or sell the home, you pay off your CHDAP second, or you can pay it off in advance in the future. If you bought a home with CalHFA and the CHDAP program at the end of 30 years, let's say you stay in that home for 30 years, you pay every payment on time. If 30 years up, that loan is due. There's also something called an MCC that I highlight down here at the bottom. An MCC is a mortgage credit certificate that can be paired with CHDAP. It's going to give you 20% of your interest as a tax credit. So we talked earlier about how the government supports home ownership by making your mortgage interest tax deductible. Well, with an MCC for eligible home buyers, you can get a tax credit that basically gives you money back. It's money in your pocket. It's an actual credit, not a not tax deduction. And it's something that is applied for at pre-approval and loan closing. You can't get it after you purchase. You got to get that MCC lined up in advance. And we love the CalHFA program for MCC. It's the best program on the market for California at this time. There is another one that we use provided by the CHF, and I don't mention CHF Platinum in this program, but it's another program that we provide that has an MCC as well. But the CHF Platinum is a grant program, carries a slightly higher rate, but it does permit a purchase with an FHA loan or other government-insured loan with a 3% grant. It doesn't have to be paid back. It doesn't require the purchaser to be a first-time home buyer, so you could own other real estate. And the CHF Platinum program, the only downside is it carries a slightly higher rate, just tiny, slightly higher rate. That's a loan program that we close inside. So I'll include some information in the downloads about CHF Platinum, but it's very similar to CalHFA in qualifying. So I zoomed up and I zoomed ahead and zoomed back. So let's talk about HomePath, which is still a factor in the market. Just recently closed a HomePath purchase for a buyer of mine, and it's something that we look at every month, and we're constantly trying to persuade buyers to consider the HomePath program. So with HomePath, these are Fannie Mae bank-owned REOs. You'll go to homepath.com, but the properties will almost always be listed in their local MLS or the multiple listing service that realtors use and that you use online. So you'll see it on HomePath, but you also see it on all the websites. The websites might not say it's HomePath eligible. They might, right? Depends on the commentary and what the agent puts in there. So always look at homepath.com and take a look at that. You can subscribe to alerts to find out when listings come available. So it requires a minimum of 3% down. It is a conventional mortgage. There's no monthly mortgage insurance, but the loan carries a higher rate. So there's no PMI. There's no appraisal requirement on a HomePath loan for the standard HomePath purchase. And you'll have a minimum FICO of about 660 and above for HomePath. So this is what the website, maybe a dated screenshot, but what the website looks like for a local screenshot on homepath.com. So let's talk about renovation loans. When we're talking about the different types of loans or different type of properties you'll see out there, we kept referring to deferred maintenance. Deferred maintenance is that euphemism for saying the house is a little messed up, needs some work, right? So if you get a property that can't be purchased because it's unsafe, it's got some problems, roof damage, siding, got pest issues, maybe needs septic work, there's all sorts of things that can be wrong with the home that make it virtually unattractive to purchase unless those things can be fixed. Well, there is a solution to that, and it is a great program. And it's one to become familiar with and one to make sure your agent that's helping you is familiar with, that you're open to using this loan program. It's called the FHA 203K. There's a streamlined version and there's a regular version. On this slide we mentioned and reviewed the streamlined version. We can go into depth about the other one if you have interest. And I do whole hour-plus presentations and trainings with agents on the 203K program. We're going to try to cover the basics here on this one slide. It's basically like a combination construction loan and first mortgage. You're borrowing based on the purchase price as well as the predicted repairs. So go out and get bids. We're putting 3%, 3.5% down based on the loan plus the repair escrow. The repairs can start 30 days after closing, must finish in 6 months. They typically finish in 90 days. You can borrow up to $35,000 over and above in the streamlined version alone, and it works out to about $31,000 and change with some of the contingencies as far as what the bids can add up to. So the best way to think about this is that you go out and we get the property appraised, but we also send along bids of what we're going to do, and the appraiser looks at it and says, oh, okay, I see the house, and then I see what you're going to do to the house. I'm going to appraise the property based on the subject to completion of those repairs. All the repairs need to be done by licensed contractors. It's very difficult to do what we call self-help, where the home buyer does some of the work. There is scenarios where that was more doable in the past, but currently self-help is challenging. So if you are a contractor looking at this and your mouth is watering to buy a house and fix it up yourself, you're going to want to have your friends and buddies in the business do the work for you. 100% may be cosmetic. You'll have no luxury type items like pools, hot tubs. You can do a certain amount of pool repairs with certain guidelines, but there's no structural work. The basic way to think of it is if there's permits required where the city can delay issuing and confirming the permit saying that it's done, then it may be a renovation program that must be the regular full 203K if it requires permits.